The very big elephant in the room, of course, is that those rent payments have been underpinned by the federal unemployment benefits and stimulus acts. $600 a week, obviously $2,400 a month. That will, even in a pricey place like Los Angeles and many places in the country, that will cover your rent for the month. Obviously, those benefits have expired, and we don't know what, if anything, are going to take their place.
To summarize again, even without the current health concern, sales volume had dropped off. Prices at best had hit their peak, but in many subcorridors had begun to decline, and properties, it was taking properties longer to sell on the open market. So that's where we were, before this pandemic hits. So now we're post March, and I know you have a good amount of analytics you're going to be sharing with us, but I thought this would be interesting. So we actually took a poll of some of our loyal viewers in terms of two things here. One, what percentage of their rent was collected in the month of July? And second, essentially, what is their sentiment currently of the market? Are they pessimistic or optimistic? And what our poll found was that 83% of the respondents in July collected at least 90% of their rent or more. And only 5% of the respondents collected 80% or less. Now, is our poll reflective of what you're finding in the market at large, that even with tenants being encouraged not to pay rent, if you will, by politicians, they have essentially continued to pay?
Very much so. I actually, in the materials we'll be going through, I actually have a slide that deals specifically with percentage of rent payment. So yes, I think to this point, it's been an encouraging story that probably in terms of how much rent is being collected, probably surprised to the positive, given the level of economic disruption. The very big elephant in the room, of course, is that those rent payments have been underpinned by the federal unemployment benefits and stimulus acts. $600 a week, obviously $2,400 a month. That will, even in a pricey place like Los Angeles and many places in the country, that will cover your rent for the month. Obviously, those benefits have expired, and we don't know what, if anything, are going to take their place. So while to this point the overall payment data and payment percentages have been very encouraging, it also seems like we may be at an inflection point, and absent some kind of new federal stimulus, that the picture could start to change pretty dramatically this month.
Yeah, and I want to return to that point, and I'll return to the sentiment portion as we look ahead. So why don't we go ahead, Steve, then and dive into what you have to share with us here.
So what I'd like to start off looking at today is CoStar's daily asking rent series. We collect about 100,000 individual rental rates, confirm about 100,000 individual rental rates in Los Angeles County every single day. Most of those through apartments.com and our network of listing sites. We also have a research team that calls out to apartments and landlords in the market to try and get the sense of what's going on. So when you collect 100,000 individual rental rates every single day, it gives you a very nuanced, real-time view of what's going on in the market. And in this case, the impact of the pandemic is pretty clear. We could see that this is countywide and includes properties with at least 50 or more units. I know many of our viewers today are kind of focused on smaller properties. For this daily asking rent series, we're focused on these 50 plus unit properties because they tend to update with CoStar more frequently. So it just gives us a good frequency of the data. But we've seen similar trend lines in the below 50 unit space as well. You can see overall, LA County rents peaked at about $2.60 a square foot in the first quarter of this year. And then obviously the impact of the pandemic is pretty clear. Starting near the end of March, rents began to fall for the first time in almost a decade in Los Angeles. Fell about 5 to 6 cents a square foot to about $2.55 a square foot. You could see it leveled out in June and actually began to show some signs of maybe the market stabilizing a little bit and rents starting to creep up again. But with this sort of second wave or intensified first wave of cases, however you want to characterize it, as that's intensified in Los Angeles, you can see rents beginning to trend downward again. So obviously, this is a very nuanced view of what's going on here. And that draws from all those rent observations we collect each day. And it does seem that in the early stages, at least, the rental rate has really kind of trended with the public health situation as things really got bad in the second quarter. Overall rents dropped as some public confidence started to creep back a little bit. Rental rates picked up again, and now as the public health situation has started to deteriorate again, so rents are showing some downward trends again. CoStar, we track the market by submarkets. We track 36 individual submarkets within LA County, and most of the areas that you touched on before, at least in Los Angeles, are contained in 3 of our submarkets, which you see on the map here. That's Pasadena area over here in kind of the northwest corner of the map. The San Gabriel Valley is, obviously these boundaries are somewhat arbitrary. We drew them ourselves, but this is the largest submarket in all of Los Angeles. There are about 62,000 market rate units in the San Gabriel Valley. And everything I talk about today, I should mention, is dealing with market rate units. So we are excluding subsidized housing, student housing, senior housing, really just trying to look at those units that are moving freely with the market at large. So about 60,000 units in the San Gabriel Valley here. You can see that stretches from Monterey Park all the way to the border with the Inland Empire. And then this last submarket here, and the map is a little bit messy because you have some waterways and canals that run through the submarket. But this is our Southeast LA submarket here, which starts just east of downtown in Boyle Heights in that area and kind of stretches down along the 5 corridor down into Pico Rivera, Whittier, La Mirada, areas like that. So we'll look at some data today that kind of breaks it down by these 3 different submarkets: Pasadena, San Gabriel Valley, Southeast LA. So just wanted to put that kind of in focus for a moment before we dug into the numbers.
No, it correlates very good with how we break down our corridor. So
perfect, great. So you can see, and this is actually a screenshot taken right from the CoStar product. This is looking at overall average rents per unit in the 3 main submarkets that we're looking at: Pasadena in green, San Gabriel Valley in blue, and the Southeast Los Angeles submarket in orange. And then you see the LA County average is that dotted black line, just for a reference point. So you can see Pasadena quite a bit more expensive than the other 2 submarkets. Average rents have crept north of $2,000 a unit. These are average monthly rents for all units, so pretty much the entire inventory from studios up to 3 and 4 bedrooms. Average rents in Pasadena had crept north of $2,000, and in Los Angeles as a whole, we were approaching that $2,000 a unit plateau. And you can see that's pretty significant growth. I've included here back during the last recession, when you can see overall LA rents were just above $1,600. We dropped down to maybe around $1,500 a unit during the last recession. But since that time, it's been nearly a decade of steady, outsized growth. And as I mentioned, in some quarters, growing by 4%, 5%, 6%. Really strong overall rent growth in Los Angeles. And while rents in San Gabriel Valley and in Southeast Los Angeles tend to be lower, that's largely due to the type of apartments there. In Pasadena, you have more modern and newly built projects and institutional grade products. In San Gabriel Valley, you have more Class B or what CoStar would refer to as 3-star product. That's maybe more workforce housing or geared toward families. And then Southeast Los Angeles, units tend to be smaller, older, generally lower quality. That's a pretty broad generalization, obviously, but this is all reflected in the rental rates here, and the average rents kind of reflect the composition of the apartment inventory in these areas. But you could see that while the average rents vary by area, the general trend lines are pretty similar, regardless of whether you're looking at Southeast LA or Pasadena or Los Angeles as a whole. We've had several years, close to a decade, of very healthy rent growth, with that largely coming to an end with the onset of the coronavirus pandemic. You can see we have already seen evidence of rent losses in both LA as a whole and in Pasadena. while in San Gabriel Valley and Southeast LA, rents to this point have not fallen. I know we're going to get into the forward-looking portion a little bit later, so we'll hold off on discussing the forecast now. So let's dig into this phenomenon a little bit here. With some areas, rents are declining and some areas are not. This is looking at the overall change in rent from that March peak that we identified. When rents peaked in Los Angeles, how much have they changed since that time? This is looking at asking rents, overall asking rents. You can see that our losers here, the submarkets that have posted the strongest losses, are clustered either on the west side or around job hubs, employment hubs in Los Angeles. These, not coincidentally, are the areas that tend to receive the most new construction. So these are the areas that have your high-end, high-priced, modern, and highly amenitized product. So you can see most of our prominent major west side submarkets: Venice Beach, Santa Monica, Greater Culver City, which includes Playa Vista, West Hollywood, downtown Los Angeles, which is obviously more new construction going on downtown than anywhere else in Southern California. So significant supply risk in downtown. You can see really pronounced losses there. And then the one that really stands out is Mid-Wilshire, which is sort of the Miracle Mile area, where rents have fallen by more than 10%. So there is a lot of newer stuff there. Mid-Wilshire is a little funny, though, because Park La Brea, the largest apartment complex in all of Los Angeles, is located in Mid-Wilshire. That's about 4,000 units just by themselves. And at Park La Brea, when they move their rents up and down, it moves the entire submarket. So that may indicate that Park La Brea just decided to drop their rent significantly, and it's being reflected in the entire Mid-Wilshire submarket here. But in general, as you look through these, it's our more expensive submarkets that are either close to the ocean or close to job centers in Los Angeles. Now, on the flip side of that, when you look at the submarkets that are performing well since the onset of the recession, places where rents have generally either held stable or actually increased, it's the opposite story. We're looking at suburban communities kind of on the periphery of LA County, areas that there is not a lot of new construction, not a lot of modern apartment product. So rents in these areas tend to be cheaper. We talked already about how affordability is such an important factor, right, in Los Angeles, and for many renting households, they're not able to select where in LA they want to live. They're just looking for anywhere where they can afford to pay the rent and still be close to family and close to their jobs. So these are areas where, you know, your commute to the major job hubs and to most of the entertainment centers and attractions in LA is going to be unappealing. But rents are much lower in these areas. As a result, demand has held up better during the downturn. And to this point, landlords and property managers in these outlying areas haven't really felt the need to lower rents. Again, with the large asterisks that a lot of rent income in these areas has been kept flowing by the unemployment benefits that have expired. Now, Chris touched on earlier the overall rent payment and the survey that he had done among your members of how many renters are paying rents. And your generally rosy report and encouraging report about amount of rent being collected squares very nicely with what the National Multifamily Housing Council is reporting. This is based on data collected from about 11 million units, a little bit more nationwide. And it essentially compares portions of what percentage of renting households paid some portion of their rent in each month. And you can see when comparing 2020, this pandemic impacted quarter, to what happened in 2019, there's very, very little evidence of the drop off. In June, the numbers were virtually unchanged from June 2020 to June 2019. So I think this has been a surprise to most people in the industry, given the level of economic disruption, tens of millions of people out of work. I think we had expected to see rent payments drop off, but that's not been the case so far. There's two very important caveats to this data, though. The first is that it only tracks households that have made some percentage of rent payment. It doesn't say what portion of rent they paid. So this doesn't indicate that everyone's paying all of their rent. And to my mind, the biggest elephant in the room and the most important asterisks is that this is really being underpinned again by the unemployment benefits stemming from the CARES Act that was passed in the early months of the outbreak. $2,400 a month goes a long way in Los Angeles. It goes even farther in most other metros in the United States. That's been enough to help people make their rent payments. Now that Congress has been unable to, and the president have been unable to come to any agreement, and these benefits have expired, it's really anybody's guess on what comes next. If we have a new round of benefits coming, if we do have a new round of benefits coming, what shape they'll take. So this graph, once you add at the end of August, when you add the August data in, may look markedly different than it's looked in the early months of the outbreak. So that's kind of the overall framework. But when we look at the health of a market, we generally look at the supply interplay between supply and demand and how that influences the vacancy rate. So this is a little bit of a scary looking chart, but it's not actually as bad as it looks. Essentially what we're tracking here are three things. Your quarterly change in demand. So that's just how many more units in a given quarter were leased or vacated relative to the prior quarter. And that's what you're seeing in these yellow bars here. The other side of that coin is quarterly change in supply, how many new units were built. And you can see during the last downturn, you actually have quarters with negative supply. That indicates that more units were demolished than were built in a given quarter. You can also see recently we've had negative demand. So that means we have many more vacant units this quarter than we did in the prior quarter. So anytime the supply, the yellow bars anytime demand, the yellow bars outweighs supply, the blue bars, your vacancy rate is going to trend downward. And that trending downward is what we enjoyed for most of the last decade. You can see that after the last recession, when vacancies peaked at about 5%, they compressed for most of the rest of the decade until they got down to about 4% and really held there for years, held right around 4%. In general, those yellow bars, the demand was sufficient to keep up with the limited amount of new building that we can do in LA. Chris, earlier you highlighted that even before the coronavirus outbreak, that we had been starting to see some changes and shifts in the market. And you can see that even before those sharp negative absorption bars, that vacancies were trending upward. Some of that was due to new supply. We were having more new apartments come online. Almost all of them high-end, Class A, 4- and 5-star, pricey apartments. So demand for those apartments hadn't quite kept up like it had earlier in the cycle. And then overall, the levels of apartment demand were slowing just a bit relative to maybe what you saw earlier in the cycle. Indeed, at the end of 2019, before anybody had heard of the coronavirus, we had some negative absorption for the first time in almost a decade in Los Angeles. And I think that ties back to the affordability concerns that we've talked about. Prices had just run up so high that there were some portion of renter households that just can't afford that rent anymore. They're leaving LA for places like the Inland Empire, Vegas, Phoenix. And obviously, as people leave Los Angeles and the population stagnates or declines, overall demand for housing is going to soften too. So that's kind of the situation prior to the outbreak. It's pretty clear what's happened since the onset of the pandemic. The sharpest negative absorption we have ever recorded in Los Angeles, and vacancies now at an all-time high, the highest rate we've ever recorded, north of 6%. The reason that Los Angeles is such a popular target for investors, for those who can get permitted to build here, because as you can see, even in the worst economic and public health crisis of our lifetimes, the sky is by no means falling.